Good evening, students. My name is C.A. Devas Gupta, and today I will be taking the topic of risk analysis in capital budgeting. Before we start, I have also uploaded the assignment questions. So, I would request all of you to please download it and keep it handy because we will be discussing those questions during the course of the session. So, students, if we start with the capital budgeting, whenever we think of capital budgeting, right, definitely two things come into our mind, which I think you would have also gone through in your previous sessions as well. One is cash inflows, and another one is cash outflows. Correct? These are the only two cash inflows, cash outflows. You'll have to calculate NPV, IRR, anything basis upon these two basic things. But a, a inherent nature of these cash inflows or cash outflows is that these are always forward looking. Okay. So once these are always forward looking, so since future is uncertain, right? So hence, there is a need for us to look into these cash inflows and outflows as on today from the point of view that what if it can go wrong or what if it can go better. Okay. Yeah. Okay. So, hence, now I would make one statement which is that is true for all future data. There can be three kinds of possibilities. Okay. The first one is certainty. Certainty means that in future, I am 100% sure that the cash flow will happen. Whether it is an inflow or outflow, that's a separate thing, but there is a 100% guarantee that this thing will happen in future. For example, 1 year afterwards, there is a 100% probability, or I can say 100% guarantee that the cash flow will happen. Now, how is that practically possible, right? Practically, definitely, yes, it's possible if those cash flows are governed by a legal agreement. Okay. If let's say there is a legal agreement between party X and party Y, where party Y have to pay party X a cash flow after 1 year, so there is a certainty through this legal agreement, correct? Hence, I can say that those transactions are bound to happen, correct? Then the second kind of scenario, I'm putting this as one. The second kind of scenario, while we always talk about futuristic scenarios, is risk. While certainty, you are 100% sure, right, on the amount as well as on the transaction being happening, but on risk, while we talk about risk, so risk is a chance, correct? Chance means that there is a possibility that it might happen, there is a possibility that something better can happen, there is a possibility that something lower can happen. For example, I can say that under a risk kind of a scenario, okay, good evening to all of you. Under a risk kind of a scenario, for example, I can say there is a cash flow of 2000. I can say that can happen, but there is a probability attached to it that only 20% are the chances that 2,000 rupees of cash flow will happen. Okay. And another one, there is a, let's say, 3,000 rupees of cash flow, but the probability is only 30% that 3,000 will happen. All these, let's say, we are seeing 1 year from now. 1 year from now, 2,000 will happen, for which there is a probability of 20. Similarly, here there is a probability of 30. Similarly, let's say there is another 5,000 rupees for which there is a probability of 40%. And let's say there is another 1,000 rupees for which there is a probability of 10%. Okay. So that means I'm saying in all these four cases, I have attached some kind of a probability, right, to different kinds of cash flows that we have, right? But here, there was 100% certainty for one cash flow itself. That's where it was called certainty. And the second scenario, which is the risk one, in which we have different probabilities and different cash flows against those probabilities. This is essentially this kind of a situation for us would be there under the risky situations. Okay, that is true under the risky situations. Then the third type of element in the decision making while you consider a forward looking data is uncertainty. No, Abhishek, you have not missed something substantial. So this is just the introduction that we are doing on the risk analysis and capital budgeting. I was just explaining from the futuristic data standpoint. There are three critical things that are there. One is either you will be 100% certain, or there is a risk element. Okay. Or third thing is that in uncertainty, neither you can estimate the cash flows nor you can estimate the probability. Both the things you can't estimate. Why? Because let's say you are very new. For example, you are launching a new product. Okay. For any new product, you don't know how the sales in the next 1 year is going to be. Correct. Even you can't assign different probabilities for different cash flows. Correct. So what I'm trying to make here at house is that under 1, 2, and 3, these are the different scenarios, and the most relevant for us in this topic will be the risky scenario, right? I think till now you would have studied capital budgeting in a very certainty environment where everything is certain. You are given that these cash flows are bound to happen. 1, 2, 3, 4, 5 years, everything is bound to happen, and hence you would have calculated LPV, IRR, all those things. But in this topic, we have to focus on risk. Why risk? Because actually, practically, if you think, it's 100%, it's not certain how the future is going to be. And one more point, there is a very thin line of difference between risk and uncertainty. Why? Because sometimes these both the terms are used interchangeably, right? But just for the understanding point of view, I'm keeping uncertainty very much separate, where you are not able to make out totally what the uncertainty part of it. Correct? You're not able to make it out what is the future cash flows that are there. Now, let us take our discussions forward on the risk part. Okay. Now, now, students, I will give you two statements. Okay. And you tell me that out of these two statements, which statement will enable you to be better decision maker. Okay. I'm taking further the discussion on risk itself. For example, if I tell you that the average cash flow is going to be 3,500. Okay. For example, I'm saying that average cash flow is going to be 3,500. That's situation number one. In situation number two, I give you information saying that average cash flow is 3,500, right? Apart from that, I also tell you that there is a risk of this cash flow of 3,500 going up or down by 500. Okay. So now I expect responses from you, students. What do you think that you as a decision maker, okay, would you think that the details given in one would be better or second would be better in order to you to take a decision? In the second case, you are given that apart from the average cash flows, okay, apart from the average cash flows, you are also getting an additional information that your cash flow might go up or down to the extent of 500. So Srishti is saying statement 2. That's correct. So statement 2 will help you or enable you to take better decision. Why? Because This statement is just a matter of fact, right? It's just giving you that 3,500 is the average cash flow. Now, whatever you have to do, you can. But as a professional, if I get this information, I can draw that my lower range of a cash flow will be 3,000 rupees, and my upper range will be 4,000 rupees. Correct? So I can go maximum down up to 3,000, but I have a potential to go up to 4,000 rupees. Correct? So using this information, yes, yes. So everyone is saying situation two, and Anushka is also saying because we can analyze the risk. That's better. Yes, Priya, you're right. Nancy, Abhishek, all of you are saying that situation two is better. Correct. So I'm explaining the situation two further now. Why it is better? Because it is giving an additional information that your cash flow can be from 3,000 to 4,000. Correct. So hence, this information is very useful in all the decisions, and hence we are studying this topic of that how this risk analysis can be used in the capital budgeting. Capital budgeting is also one of the decisions only, right? Whether we invest or not. Correct. So hence, this is why it is getting used. Okay. Yes, Chetna, you're right. Ranga Vijla, yes, you're right. Statement two. Abhishek, that's right. Situation two is showing the complete picture, right? So this is what the basis or the base of this topic is. Okay. Now let us go to some of the technical things. So in the above statement itself, okay, this average, this average in statistical language is called as mean. Okay, it's called as mean. Simple. We will come to it how to calculate this average, how to calculate this mean. Correct. But I'm just saying that this is nothing but mean. Similarly, risk is what? Standard deviation. Okay. Now, students, please note that I have specifically mentioned here plus minus. Okay. I will tell you the significance of this once we cover the standard deviation. So at that point of time, I will relate it back to this, why we are using this plus and minus. But statistically, I'm saying that average is a mean and risk is a standard deviation. Correct? And how to calculate them? Yes, we will cover. So, what is the key takeaway from here is that without standard deviation or without risk, if I only have average, then still my decision making will not be a informed decision making. Correct? If I have to be holistic in my decision, I have to confirm, I have to take into account the standard deviation or risk factor as well. Okay. Yeah. So coming to the next part of the thing, which is what are now the techniques? Okay. Now, there are different techniques to evaluate or to analyze the risk. Okay. Now, within these techniques, we will first understand some of the basic terms. The first one is probability. So, students, probability is nothing but the chance of an event. So, Manya Ahuja, you're right. You're bang on the point. On the standard deviation, it's a square root and hence it gives two values. Yes, Ranga Vajula, you're right. Mean is the summation that we are just going to study now. But as far as the probability part is concerned, okay, so what is this probability? Is chance of an event occurring, correct? Now it can vary from 0 to 1, that we all know. Minimum it is 0 and maximum it is 1, correct? And always this probability is always used in situations where these are forward looking situations, always used in forward looking situations, correct? Because in future I have to assign a probability for an event to occur, so that there is a cash flow that is happening, there is a cash flow that is not happening, correct? So that is where the probability is. So I hope there is Srishti, you're right, the definition of probability you have mentioned is right. So hence probability is very much clear, right? It is a chance of an event happening and it varies from 0 to 1, correct? Now using this probability, we have to find a mean, right? Now, what is mean translates into is, we always call it as expected value. Why we call it as expected value? Because it is the best expected value out of the entire probability and out of the entire different cases, correct? So we, in now coming back to our curriculum, we have to calculate the expected values from two angles. One is expected net cash flows. Second one is expected net present value. Okay. So wherever you see this word expected, that means the best possible case, and the best possible case is nothing but the mean out of that probability, right? So expected net cash flow will be calculated as, we will take the individual cash flows, so net cash flows individually, and multiply it with the respective probabilities of each and everything and take a summation of it. So summation of, when I, which is the number of observations from 1 to n, we will take a summation of net cash flow, multiply it with the respective probabilities and take a sum of it. Okay. So this is called as expected net cash flow. Okay. This we will go through in the practical questions as well. Although it's a very simple calculation. And in this case, if you see, it is mentioned as expected net present value. Okay. So expected net present value. In the present value, you will just divide it by a 1 plus discount rate. Simple. So expected net cash flow, we will divide it by 1 plus discount rate, which is, I'm assuming to be K in this case, this raised to the power of T. Correct? T is nothing but the time. Let's say 1 year, 2 year, 3 year. And for all those 1 year, 2 year, 3 year, we will do a summation. Simple. Okay, students? So this is, I mean, from the formula standpoint, I have written it. It's very easy, very simple in terms of the entire calculation. Now, let us go to the question number 1. As I told you earlier, the assignments are already uploaded under the download assignments tab. I request all of you to please download it and keep it handy. And we are now referring to question number 1 of that assignment. That will clarify whatever we have studied till here. It says that probabilities of net cash flows for 3 years of a project are as follows. Year 1, year 2, year 3. First of all, this project is for 1, 2, and 3 years. This is 0, 1, 2, 3. Okay. So 3 years this project is for, and within all the years, there are different cash flows. Okay. And there are probabilities to it. Okay. Now, what the question is asking us to do is calculate the expected net cash flows, the same thing that we have just seen. Okay. and also calculate the net present value of the project using the expected cash flows using 10% discount rate, and the initial investment is 10,000. So, Devalina Roy, you're asking that in this case, I and T is same. I would say no. So, I here is within a particular year, what are the different possibilities? See, I'll just show you what is the difference between I and T from here. Just a minute. Okay, so if you see here, so I is what within 1 year, what are the number of chances, which is this. So this is I is equal to 1, I is equal to 2, I is equal to 3, I is equal to 4. Whereas T is the number of year. T is equal to 1 year, T is equal to 2 year, and T is equal to 3 year. This is what T is as far as this is concerned. These two things are concerned. Okay, Devalina? Yeah. So coming back to this question, now first of all, we have to calculate the expected net cash flows. Calculation of expected net cash flows. Okay. So in that case, we will just see what is the year 1. Similarly, year 2 and year 3. Okay. So we will just mention here what is the cash flow, which is 2,000, 4,000, 6,000 and 8,000. Correct? And respective probabilities is 0.1, 0.2, 0.3, 0.4. If it is mentioned in decimals, we can just simply say 0.1 is 10%, 0.2 is 20%, correct? So it's one and the same thing. Then the expected value. Now here if you see the expected value is what? 2000 multiplied by 0.1. Similarly, for the respective cases also, we will do it like that only. 200, 800, 1800 and 3200. This multiplied by this multiplied by this. And then we will take a summation of all these things here, which comes as 6,000. Then Srishti, your answer is right. Expected net cash flow is 6,000 for year 1. Srishti, year 1 is 6,000, year 2 and year 3, let us see. So I think cash flows are same only. So I'm not noting down cash flows again. I'm just noting down the probability of year 2, 0.2, 0.3, 0.4 and 0.1. And expected cash flow will be 400, 1200, 2400, which is 0.4 into 6,000. And similarly, last one is 800. So it's 4,800. Year 2 is 4,800. Srishti, your answer is correct. Then year 3, the probabilities are 0.3, 0.4, 0.2, 0.1. Sorry. .2, 0.1, and hence the expected net cash flow will be 600, 1,600, which is 4,000 into 0.4, correct? Then 1,200 and then 800 finally. So the total is 4,200. Kamal, your answer is right. Year 2 is 4,800 and year 3 is 4,200. Even Srishti, your answer is right. Year 3 is 4,200. So this is very easy, very simple, expected net cash flow. So I think this part we have understood. Okay. Now let us go to the next part of the question. So the next part of the question is saying calculate the NPV using the expected cash flows. Okay, expected cash flows we have already calculated 6,000, 4,800 and 4,200. So we can say that present value of cash inflows is equal to 6,000 divided by 1.1 because 10% is the discount rate, correct? Plus 4,800 is year 2, so 1.1 raised to the power 2, and 4200 is for year 3 times 1.1 raised to the power 3. Okay, Chetna, you are right. 4200 for year 3. Kamal will see the NPV now. So, if we solve this, the present value of cash inflows comes as 12,573. This is present value of cash inflows. Hence, NPV will be 12573 minus 10,000. 10,000 was our initial investment, correct? This is also mentioned in the question. Manan, you are right. I think there is some rounding up there, but 12,577 is still okay. So this minus this, it comes as 2573. So Kamal, Roshia, your answer is correct. 2573 is the NPV. So this is what the simple question is. And this we can say that this is the expected net present value, correct? Because this is calculated from the expected cash flow. Okay. And this is nothing but mean, right? Whatever we have calculated here, this is mean for year 2, and this is mean for year 3. Correct? In statistical language, we can say that these are the means. Now, let me go to the next part of the concept, which is variance. Okay, students. So, what is a variance, or what is this statistical term called variance? So, variance is nothing but, now in this example, I will explain it through this example. You have calculated that the mean is 6,000. Let's only focus on year 1. So, in year 1, we have calculated that the expected or the average value is 6,000, but the individual values are very much different. Okay. So, if you see my first part, I told you here that in these two statements, till now we have calculated that what is the average cash flow. Now we will go to how to calculate the risk part as well, right? So I'm just giving you some kind of indication that this 6,000 is nothing but the average cash flow. But within the different cash flows, what is the risk, or what is the dispersion, I can say, or in other word, I can say what is the variance. Okay, so variance measures what? Variance measures the deviation of individual cash flows from its mean. Okay, your answer is correct. Okay, so variance measures the deviation of cash flows from its mean. Okay, and how it is calculated? It is denoted by this, which is mu square. Okay, and what we do is we just take the net cash flow for a respective scenario or for a respective probability and reduce it from the expected net cash flow. Okay, multiply it with the probability and take a sum of it. I is equal to 1 to n. So Anushka, you are right. It's a double of standard deviation, but double not multiplying 2 multiplied by its exact square of standard deviation. Okay. Yes. Srishti, you are saying you're right. There is a deviation from individual cash flow. That's correct. So now if you see, this is what? This is nothing but your average, or this is a mean, correct? So what we are doing is we are taking each and every observation. We will reduce it from the average, multiply this entire thing by the probability of that cash flow and take a simple summation of it. We will simply get variance and we will just take a square here. Now, what is the reason of this square is, now if you see, our average was how much? 6,000. And the different cash flows were 2, 4, 6, and 8. Correct? Now, why we take a square here and hence we call it as variance because here also the square comes, correct? Why we say that is because if you do this minus this, you will get a negative 4,000. And if you do this minus this, you will get positive 2,000. And the moment you take this as is, so this will give you negative 2,000, which is not right. Correct. What is the right thing to check here is there is a 4,000 gap from the first one, and there is a 2,000 gap from the second transaction or this 8,000 transaction. Correct. So ultimately, I should take a square of these two, correct, so that all the negatives will turn into proper positives, and positives will still be positives. So in its entirely, I will get a proper, what I can say, a deviation, right? Otherwise, the positives and negatives will get net off, and I will get a very distorted answer, which will not be true, correct? So hence, statistically, we always denote or we always take a square of this multiplied with the probability, take a summation that is called as variance. Okay, that is called as variance. Now, within this variance, okay, let's say the variance is very high. Okay, the number is very high or the number is very low. I'm talking about variance here. Okay, so that means if the variance is high, that means the dispersion or the deviation within the individual cash flows is very high. Correct. For example, something is 1,000, then another thing is 8,000, then again suddenly it's 2,000. So if you can see, there is a very huge level of deviation in the observations. Correct. But if variation is low, that means the deviation is also low. Correct. So that means that observations will change like this. 1,000, it will go to 1,500. Sorry, 1,500. Then it can come down to 1,200. Again, it can go to 1,300. So you see the change here and the change here. Correct. And hence, we can conclude that where variance is high, the risk of a cash flow is also very high. And where the variance is low, the risk of a cash flow is also low. Correct? But variance is not risk. Again, I'm saying variance is not risk, but I'm saying it indicates that there is a high amount of deviation or dispersion within the data. Okay, that will definitely lead into a lot of irregularities in the way you deal with the risk analysis in capital budgeting. So this is a very valid observation that we have to keep in mind. Okay, now this is what variance is. Now, if you talk about standard deviation, okay, so let me just put it like this: standard deviation is nothing but a square root of variance. Can I mention it like this? And hence it is just mu, because this will get cancelled from this side. So, okay. So variance square root is a standard deviation. And as it was rightly said, I think by Madan, yeah. So whenever we open a square root mathematically, we always put plus minus, correct? Because here also I explained you, if a negative sign also you do a square, you will get a positive 16, correct? Negative 4 square is equal to positive 16. Hence, while you come from here to back here, hence you always put plus minus, and hence I have taken here in my example that the risk, which is called the standard deviation, can always be plus minus whatever is the value. Correct? I hope you're able to make it out. If it is plus minus, there are equal chances that the actual cash flow will be low, and there are equal chances that the actual cash flow will be higher also to the same extent. Correct? So I think that's one thing which I just wanted to connect. But the major key takeaway from here is that variance is first need to be calculated to arrive at standard deviation. And standard deviation is called as risk. Okay. Standard deviation is called as risk. Abhishek Kumar is saying from variance we can pick signals. Definitely yes, we can pick signals as we have seen in the earlier tick as well. Now this is okay. Now let me again expand this discussion further. For example, now you have two projects, project A and project B. Okay, you have two projects in line which you are evaluating that which project to be undertaken. Now, as I told you that definitely only one information will not work. Let's say I can tell you that the average cash flow, you can refer this as cash inflow as of now, correct? Just to avoid any confusion. Okay, so the average cash inflow is, in this case is let's say 500 and in this case is let's say 1200. Okay, in both the projects. So is this information enough for you? No, because while we have gone through this, we know that we also need to know that what is the risk that this 500 can go up and down, or what is the risk that this 1200 can go up and down. Okay. Okay, so what I'm giving you additional information is standard deviation or risk. Standard deviation or risk, which is one and the same thing, is also given to you. Let's say it is 100 and it is 120. Okay. Now, can any one of you tell me that which project is better, whether project A or project B? I have given you this set of information. You tell me which project is better. Meanwhile, I take the queries. So Sushil Kumar is asking how SD is risk. Okay. So Sushil, as I told you that what is risk? Okay. Risk is that in future, whatever you think in your mind that let's say in future the cash flow is going to be 3500, but actually it is not going to be 3500. It is going to be either higher or lower, or it can be 3500 also. Correct? It can be anything if you think it from a very practical standpoint. In that case, what you need to know is that what is the absolute amount by which your average can go up or down basis the details given to you. Okay, so that is risk, correct? And the same thing statistically is done by standard deviation, because what standard deviation does is standard deviation measures. See, first of all, standard deviation is derived from variance. Variance measures that what is the deviation from mean. What is the deviation from mean? That is what variance measures, correct? Hence, and standard deviation is a square root of variance, and hence this standard deviation is as good as risk, because in risk also we are trying to see that by how much our average will change. The same thing is given to you by standard deviation. Statistically, the same thing is given to you by standard deviation, either plus or minus. Your cash flow will change to the extent of standard deviation. Okay, hence SD is risk. Manish, I would say variance is square of SD. Don't say it is double of SD. Double means we are not multiplying 2 into SD to receive at to get the variance, right? We do SD square to get this thing. So don't say it is double, always say it is a square. Okay. Now see, some very interesting answers are there on this question that I asked. Okay. So let's see one by one. Another is saying B more risky and more cash flow. Okay. So B B is definitely more risky because the standard deviation is 120, but definitely the cash flow is also more. Okay. Develina is saying project A. Okay. Maybe because Develina you would have compared it. This is the risk, correct? And in this, since the risk is low, you are preferring project A, correct, Develina? Srishti is saying project B. Okay. Let me conclude Srishti. Why Srishti is saying project B? Priya Burana is also saying project B. Abhishek Kumar Singh is saying project B as the cash flow of 1200 with 10% of risk in project A cash flow is 20%. Bang on, Abhishek. I think Abhishek, you are bang on the point. I will explain that point. Okay. Devilana is asking, sir, what is the difference between deviation and risk? Okay. So, see, deviation. Now, if you see, let me take this query first from Devilina. See, Devilina, now if you see standard deviation, is also kind of deviation, correct? So the name itself suggests standard deviation is also a deviation only, right? So what I can say is deviation can take many forms. Deviation can take many forms, SD being one of them, in which the deviation is calculated from the mean, correct? Hence, standard deviation is called is also called as risk, but deviation can be from other things also. For example, I want to calculate a deviation from median, not from mean, right? In that case, even I want to calculate a deviation from mode, correct? From any other central tendency, if I want to calculate deviation, that's a separate deviation. But deviation, standard deviation is also one kind of deviation only. Okay. So I can say that risk is also one of the type of deviation, correct? Because standard deviation is one type of deviation and risk is also one type of deviation. I hope I am clear. Now, Chetna is saying project B, okay. Sushil Kumar Barik is saying project B. Kamal Roshia, B has a higher inflow but a bit higher risk. A has a lower, okay. Kamal got your point. Srishti, project B. Okay, okay. Srishti is actually interpreting it. That's again a right kind of interpretation. 1200 minus 120, it will be 1080. So lower range will be this, and upper range will be 1320, right? And here it's 400 to 600. Okay, some interesting answers I am getting. Anushka is saying project A is better. This is difference between actual and perceived motion. So Chetna, your question is risk is difference between actual and perceived motion. I can say risk is the difference between your best outcome and all your possible outcomes. Okay. Again, I'm coming back to this query. See, this is your best outcome. All this is futuristic. Huh? Nothing is in past. All this is futuristic. So let's say this is your best outcome. Okay. And let's say here are your other possible outcomes also. There are a lot of possible outcomes, but this pillar is your best outcome, correct? Correct. So what is risk is? Risk is that how much these possible outcomes, I can say that these are possible outcomes, not best. Best outcome is always mean or average, as we have studied, okay? And these are also possible outcomes. So risk is that how is your possible outcome varying with the best outcome, how it is getting deviated. What is the amount of deviation between a possible outcome and a best outcome? Okay. Okay, Chetna. Vedashri is project A, is saying project A. Manish is saying project B. Okay. Now, Rangabizula is saying project A because it's higher the risk that might reduce my inflows. If it is lower, it may give me more inflows. Okay, what your point? Kushi Goyal, project B less risky. Yes, Kushi, I think you are bang on the point. The fact that you have mentioned Anushka, project B, Chetna, Anushka, because the higher risk, higher is the return. Okay, Anushka, we will come to that higher risk and higher will be the return. I will use the same line in the next concept. Vedashri is saying project A. Vedashri, I hope you already know the concept of coefficient of variance. So I think Vedashri is also bang on the point. Sarthak is asking how we calculate risk. So Sarthak, as I told you, that risk is calculated as standard deviation, and how we calculate standard deviation is what we have discussed already. Okay, it's calculated as a square root of variance, and how we calculate variance is what we will do through a question also. Okay, now let me come to it. I think a lot of good discussion that we have done on project A and project B. So now if you think very logically, definitely, as I told you that you need both the data points to make an informed decision making. You can't only conclude this is the average cash flows, and you can't only conclude this is the standard deviation. Why? Because if you only conclude this is the average cash flows, then project B is better. If you ignore the risk, correct? If you only take this, then project B is better. But if you only take into consideration risk and ignore the average, then project A is better, correct? Because A is having a lower risk, correct? Hence, I'm saying you need to consider both the things. There is a concept called SD divided by average. This is called as coefficient of variation. How can we do this here? 100 divided by 500. Here it is 120 divided by 1200. This is 0.20. This is 0.10. Okay, now what is this coefficient of variation? Coefficient of basically we say that this is the coefficient of variance. Okay, now this says that what is the per unit risk of average? For 1 unit of mean, what is the risk? Simple. Risk slash standard deviation. I will use both of them interchangeably. Okay. Risk and standard deviation can be used interchangeably. So, coefficient of variation says that between both the projects for 1 unit of mean, what is the risk that I'm carrying? In this, it is 0.2 and this, it is 0.1. So, definitely project B is better. So, Manan, you can express coefficient of variance in any form. It's better to always present it in decimal form. You can present it in percentage form as well, but mostly it is presented in decimal form. Okay. Okay, students. So this is another good takeaway that I wanted all of you to have a look on this. So till now we have studied probability. Then we have studied variance. We have also taken a look on standard deviation, which is also called as risk. Then we have also studied that what is the coefficient of variance. Correct? Now let us quickly do a practical question to understand how all of this thing gets calculated. So it's directly asking us to calculate coefficient of variation based on the following information. Okay, now if we have to calculate the coefficient of variation for project A and project B, first of all, we need to calculate variance and standard deviation and average, right? Then only we would be able to calculate it. So first of all, for calculating the standard deviation or variance as well, we need to calculate the mean, right? So let us first of all calculate calculation of expected cash flows. Okay, which is nothing but mean. Okay. So Sarthak is saying how we minimize the risk. Okay. So Sarthak, on this part, see the risk minimization is possible through a lot of techniques. But in this case, we are just analyzing the risk. Okay. In this entire part, we are not trying to mitigate the risk. We are just trying to analyze the risk. That what risk is having an implication on our capital budgeting decision. That's all. But to answer your query, how do we minimize the risk is there are a lot of theories, there are a lot of tools that are used to minimize the risk. Okay. For that, I think in our final curriculum also, there is an entire chapter on the risk mitigation, on portfolio management, right? So there are a lot of theories, there are a lot of things using which we can manage the risk. Correct. But as of now, let's focus our discussion point only on analyzing the risk. Okay. For example, but just to give an example, let's say FNO, futures and options are one kind of a thing to manage the risk. Not to it can also increase the risk, but it can eventually lead you in terms of the management of the risk as well. Correct. So those are the things that are separate, entering into a forward kind of an arrangement. Okay. But I will keep that as separate because that's not part of the curriculum in intermediate. So here we have to just analyze the risk. Okay. Now I'm just quickly putting, so this is possible event. They have mentioned A, B, C, D, E. Okay. So project A is coming as, so the net cash flow that they have mentioned is 10,000, 12,000, 14,000, 16,000, and 18,000. This is what they have mentioned. So the probability that they have mentioned is 10%, 40%, 20%, and 10%. So expected cash flow will be, okay, expected cash flow will be 1,000, 2,400, 5,600, 3,200, and 1,800. We have just multiplied these probabilities with this and taken a summation here, which comes as 14,000. Half. Srishti, your answer is right. Anushka, your answer is right. Project B, similarly for project B, let us quickly calculate the expected cash flow. So first of all, the net cash flow is what? 26,000, 22,000, 18,000, 14,000, and 10,000, right? Then the probability is what? 10%, 15%, 50%, then again 15% and 10%. Okay. Then expected cash flow will be just simply taking a multiplication here, which comes as 2,600, 3,300, 9,000, 2,100, and 1,000. This comes as 18,000. The answer is right. Vishnu, your answer is correct. Chekta, your answer is correct. Debulika, your answer is correct. Okay. So till here we have calculated the expected cash flow. Now let us calculate the variance. Correct. Next step is variance. Then we can calculate standard deviation, and then we can calculate the coefficient of variation. Okay. Calculation of variance. So we will have to calculate separately for project A and project B. So here we will calculate for A, here we will calculate for B. Okay. So event is A, B, C, D, and E. So for the first one, now if you see what is the average is 14,000. Individual cash flow for project, so possible event A is 18,000, right? So what we are going to do is 10,000 minus 14,000. We will take a square here, correct? Because this is a negative 4,000 that will get converted into a positive deviation, multiplying it with the probability. So this will give us 16 lakhs. Simply here also 26,000 is the first cash flow, right? For this, and average is 18,000 as here. This square multiplying it with the probability. So we will get 64 lakhs. Okay. Similarly, if we calculate here, so B it will be 8 lakhs. C it will be nil because it's same. Again, it will be 8 lakh here, and again it will be 16 lakhs. Simply here it will be 24 lakhs. It will be nil. 24 lakhs here as well, and 64 lakhs here. Okay, students. Then we will take a total of this. As I have mentioned in the formula of variance, we have to take a summation. Yeah, this one is the formula, right? We have to now take a summation. So while taking a summation, it becomes 48 lakhs, 1 crore 76 lakhs. This is all variance. Using this, we can calculate the standard deviation, correct? Under root of this 48 lakhs here. And here it will be under root of 1 crore 76 lakhs. So this will be given as 2190.89. If I take a square here and 4159, using your simple calculator, there is a under root button. If you press this figure and press that under root button, you will get the respective numbers. Srishti, your answer is correct. Okay, now let us calculate the coefficient of variance. Okay, we basically say this coefficient of variation. Sorry, the coefficient of variation. So for project A and project B, project A is what? Project A, what is the standard deviation? 2190. Please note here, we always put standard deviation in the numerator. Okay, 2190.89. Srishti, your answer is correct. Manan, let me check. Okay, yes, this is 4159.23 divided by what is the average cash flow for project A? 14,000 and 18,000. So this is divided by 14,000, this is divided by 18,000, and respectively we will get the coefficient of variation 0.1565, and here it is 0.2331. Yeah, Manan, I think your answer is correct. Srishti, your answer is right, 0.2331. Manish, your answer is correct. Perfect. Yeah. So I hope this coefficient of variation calculation is pretty much clear. Now, sorry. Now using this, which project is better? Definitely project A is better, correct? Using coefficient of variation, we can conclude that project A is better because the risk per unit of cash flow or risk per unit of average is low in case of project A. Okay. Mishika, your answer is right. Gilbert and MC, project B is 0.233. Srishti, okay. Great. Okay, now let me move on to the next part. Sorry, before moving on to the next part, let me discuss this question number 3. Okay, this has come in November 2020 attempt. Okay, we will just go through this question. Okay, so A Limited is considering two mutually exclusive projects, Project X and Project Y. Okay, just read the question very carefully in examination as well while you practice the questions. So they are trying to say that these both of them are mutually exclusive. They don't have any relationship. Project X is a different project and Project Y is a different project. You have been given below the net cash flow probability distribution. So Project X, they are saying that net cash flow is this, and Project Y net cash flow is this. So first of all, there is no question of cash inflow or cash outflow here. Okay, so don't get confused and don't search for that kind of information in the question, because the question is also saying you net cash flow. Simple. We will go with what question is saying. Okay. It is asking you to compute the net cash flow expected net cash flow of each project, which is nothing but mean. That we have done in the previous question, step 1. Variance of the project that we have done in step 2 of the previous question as well, right? So if you see here, here as well, yeah, here first step we calculated the expected cash flow. This is the first part. Second part, it is asking us to calculate the variance. Okay. Just a second. Yeah. Okay. Then it is asking you to calculate the standard deviation, which is even very easy. So this is nothing but a square root of step 2, correct? You will get a standard deviation. And the last part, it is asking you to calculate coefficient of variation. Very easy, very simple, and doable. It's very similar to the question number 2 that we have done. So I would request you all to please go through this and do it as a homework, as a practice. Okay. Mara and Srishti, your answer is right. Let me go to the next part of the concept. Okay. Okay. So next part says, so till now we have studied the more from the statistical point of view, right? Variance, coefficient of variation, standard deviation, mean, average, all those things. Now let us go to the core financial practices. Okay. So there is a concept called risk adjusted discount rate. This is called as RADR. Yes, Ishika and Abhijit, your answer is also right. You can attempt the exact 100% question afterwards, but please now concentrate everyone here. So, students, this is called as risk-adjusted discount rate concept. Now, what does the concept say? Very easy, very simple. Just it goes with the normal thought process. If you think, what is a discount rate? Okay, I will start with a very basic. So discount rate, whenever we think of, normally, one thing comes to our mind, it is nothing but an interest rate sort of a concept, right? I'm saying that essentially a discount rate might be different with the interest rate, but conceptually both of them resonate, correct? Can any one of you tell me what is the need of paying an interest? Why there is an interest rate or why there is a discount rate? Why? What is the basic need? Because this risk-adjusted discount rate, the concept will come from there only, from that discussion only, right? So if someone of you can put that thought on the question handle, what I'm asking is that what is the need of a discount rate or slash interest rate? Why there is a need of these two things? I will wait for some of you to respond. Okay. What are the responses? Srishti is saying because of time value of money. Okay. Manan is saying inflation, time value of money. Perfect. Abhishek Kumar Singh is saying time value of money, and Devarana is also saying time value of money. That's correct. You all are totally correct. Now, let me tell you, definitely yes, time value of money is one. Okay, time value of money is one, which is nothing but general inflation, I can say. Correct. This is because one basket of goods today will not cost you the same. If you're going to purchase the same basket of goods 1 year afterwards, or let's say 2 years afterwards, right? Hence, that is called as a general inflation or time value of money. Simple. Kuluru, you are also right. Anushka, to get a return on investment, time value of money. Bhakti, you are right, inflation. So this is all this, correct. Now the second reason why the interest rate or the discount rate is there is risk. Okay. The second reason, if you think it, let's say today bank lends someone some money. Okay. Someone borrows money from the bank. Is there a risk of non-payment of the principal, or there is a risk of non-payment of interest? That is the risk that bank is carrying, correct? And generally that is determined by the credit rating agencies, correct? Credit rating agencies will rate the risk profile of a particular corporate, correct? That's how they do. That means, and if better credit rating you have, lower interest rate you get, correct? Now the lever which bank pulls it down is the risk lever there, correct? Because time value of money will remain constant, correct? So if your credit rating is better, risk is low, interest rate will also be low. If your credit rating is poor, the risk is higher, interest rate will also be higher, correct? So can I say that risk is also an inherent part of a interest rate and hence discount rate, correct? Okay. Srishti saying opportunity cost of using it, another alternative, which is covered here itself, correct? All this is this. And I'm just categorizing everything into two buckets. One is everything except risk and one is risk. Okay. So hence, here is because of that risk. Now, someone had also mentioned in the talk where I said that I will use the statement higher risk, higher return. Higher risk will mean higher interest slash return. Will it also mean higher discount rate? And hence, we will use this higher discount rate as RADR, which is risk adjusted discount rate. Simple. Because in this discount rate, the plain discount rate, you are adjusting that for risk. For example, now under RADR approach, okay, we say that the discount rate is a sum of two things. One is the risk-free rate of return plus risk premium. For example, the government bonds, the bonds of the government in the market are getting traded at let's say 7%. Okay. And so what were you doing till now? Till now, let's say in the normal capital vesting, you would be discounting it basis 7%. But if there is some additional information given to you in question, in which it says that there is a risk premium of 8% on the profile of the project in which you are going to invest, because this risk premium will depend on a lot of factors, but this will be given to you. So hence, in that case, the risk adjusted discount rate will be 15%, and you will have to discount the cash flows using 15% and not 7%. You will have to discount it using 15%. That is what RADR. The moment you do discounting using 15%, your discounting factor will increase, correct? Because your denominator will increase and hence your present value will decrease, correct? So I can say that it has the impact of reducing the present value of cash flows, correct? It will reduce, right? Because higher discount rate you use, your cash flows becomes lower. Simple. Chetna, CAPM approach, yes, I can say, but CAPM approach says that risk premium we will have to take in relation to beta, correct? So here that we are ignoring, instead of that beta, I am saying that risk premium we will have to take for that particular project, correct? Okay, students. So now what this RADR is doing, RADR or risk adjusted discount rate concept is asking you to use higher discount rate to discount the cash flow. Simple. That will take into account the element called risk. The moment you do that, automatically your present value of cash flows will come down and it will get adjusted. Okay. Now there is a basic limitation here. What is a limitation? What is the limitation here is that in each and every year, you will use a discount rate of 15%, correct? So that means you're making an assumption that every year, your risk is only 8%. Okay, which might not be too practically, because practically again I'm saying that this 8% of risk premium can be true for first year, but for second year, let's say it can be 9%. Third year, it can be 10%. Fourth year, it can be 7%. It can be anything, right? It can depend on and it can vary from year to year. But this thing we ignore in RADR. RADR hence have a limitation that every year you will assume that the risk premium is constant. Okay. Hence, there comes the second approach. Certainty equivalent approach. Now listen very carefully, students here. See, for just a second. Let me write it here. Yeah. Okay, so certainty equivalent approach. Now, what I was trying to say is in capital budgeting for NPVs, you need two things, right? One is the cash flows, and second one is interest. So, interest part is already we have studied under RADR, risk adjusted discount rate, correct? Now, for cash flows, okay, let me put two situations. Under this certainty equivalent approach, please assume that there are two situations. For example, now you are told that under situation 1, you will have to bear the risk and you can get 2 lakh rupees of cash flow. Okay, so this is a risky cash flow. Okay, situation 2, what you are given is that you will get a cash flow of 1,50,000, but it will be guaranteed to you. There is no risk. There is no risk. This cash flow is guaranteed, 100% guaranteed. Or I can say this is a certain cash flow, right? We in the first part, in the very first slide, we have seen certainty, risk, and uncertainty. I am saying you are given situation 2 where you are getting certainty, situation 1 where you are getting risk. In this example, okay. Now, what does the certainty equivalent approach says? That you know about this. Okay, there is a risky cash flow, but you will have to convert that risky cash flow into a guaranteed cash flow or a certain cash flow. Hence, it is called certainty equivalent. What if I convert this 2 lakh rupees of risky cash flow? I strip this down into two pieces. One is the guaranteed cash flow, and the second one is risky cash flow. So the guaranteed cash flow will give you 1,50,000, and here I can say instead of risky cash flow, I can say risk premium. Because of risk, the person will expect 50,000 more in cash flow. Correct? So this is nothing but 2 lakh minus 1,50,000. So what we have done is we have bifurcated this 2 lakh rupees into guaranteed and risky premium amount. And we will use this guaranteed amount in our NPV calculations. Because this is a certainty equivalent amount that we will get for this 2 lakh rupees. Correct? And to convert this, there is a coefficient called certainty equivalent coefficient, which is actually calculated as 1,50,000 divided by 2 lakh into 100, which is 75%. This is called as certainty equivalent coefficient. So if you multiply this certainty equivalent coefficient in your risky cash flow of 2 lakh, you will get a guaranteed cash flow. So if I do 2 lakh multiplied by 75%, I will get 1,50,000 as a certainty equivalent coefficient, certainty equivalent cash flow. And I will use the discounting. We will do this through the discounting. Now let me take the question. Manish is saying risk may increase or decrease. That's right. That's right. Manish is saying, can we take different risk for different years for PV? That is given under this certainty equivalent approach. This we will study through question going forward, and we will understand how we can tackle this. Okay, how we can take different years, different risks. Okay, so in a nutshell, as I told you that NPV, there are two things that are required. One is this cash flow and one is interest. Interest is taken care in RADR. Cash flow is taken in certainty equivalent approach. Okay. Now we will break for 5 minutes. We will come back and resume at 7:24. Yes, students. So welcome back. Just a second. Okay. Yeah. So let us quickly do this question, and then we'll see. Yeah. So let us go to the question number 4. Okay. This is again from the same assignment that has been uploaded. Question number 4 states that Forum Limited is using certainty equivalent approach in the evaluation of risky proposals. Okay. The following information regarding a new project is as follows. Just hello. अच्छा. Okay. Okay. अच्छा. Okay. 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 Now okay. Now I can also hear you. So yeah, students. So what I was saying is, let us do this question number 3. Sorry, question number 4, and then we'll see. So question number 4 says Gaurav Limited is using certainty equivalent approach in the evaluation of risky proposals. Okay. So first of all, he is using certainty equivalent approach. The following information regarding a new project is as follows. What are those? Year 1, 0, 1, 2, 3, 4, 5, and the expected cash flows are given, and there is a certainty equivalent quotient also given. Now, what is this? This is the same 0.75 or 75% that we have calculated earlier. Okay. This is what they have given. And this will be used to convert these risky cash flows into guaranteed cash flows. Correct? Guaranteed cash flows will be arrived by multiplying this. So what they are saying is riskless rate of interest on the government securities is 6%. Determine whether the project should be accepted. Very easy, very simple. So first of all, we will do one thing. We will calculate, or let's say we will determine the NPV. Correct? We will determine the NPV. So we will put year here, year 0, 1, 2, 3, 4, 5. And what is the expected cash flow here? 4 lakhs, 3 lakh 20,000, 2 lakh 80,000. These are all risky cash flows that we are putting first, which includes an element of risk. Okay. Then 2 lakh 40,000, then 1 lakh 60,000. What is the certainty equivalent coefficient here? That also let us note it down. 1. Please note this is a cash outflow in the 0 year, right? That's why it is put as negative. 0.8, 0.7, sorry, 0.6, 0.4, and 0.3. This is the certainty equivalent coefficient. And if we multiply this with the expected cash flow, we will be arriving at risk. I can say the certainty equivalent cash flows, right? These will be certainty equivalent cash flows. So what I will do, I will just multiply it here. So 4 lakh will be 4 lakh. This 320 multiplied by 0.8. Okay. This will become as 2,56,000. 280 multiplied by 0.7. 1,96,000. 1,56,000. 96,000 and 48,000.
Here we will mention the present value factor at the rate of 6%, correct? So which is 1, 0.943, 0.890, 0.840, 0.792, and 0.747. And hence we will get the present value cash flows, which is the net one. Okay. So here it is simply multiplying this and this, correct? So 4 lakh will be the initial cash outflow. Then 256 multiplied by 0.943 comes as 241,408. Then comes 174,440. Then it is 131,040, 76,032, and 35,856. So the total here comes as 258,776. Okay, students. So this is what the total NPV will be. Now, if you see, this is just a simply net present value using the certainty equivalent approach. Debolina, I think you are referring to this. Yes, these both numbers are right. 256 and 196. Okay. So now one more point to be noted here is I will just bring down some reasons of difference between both of them. See, the name only is very dangerous, certainty equivalent, but the treatment is very simple. You will have to first convert the risky cash flows into a certain cash flows. Those certain cash flows you will have to discount using the risk-free rate of return. Simple. Correct. Srishti, your answer is correct. Now, what I'm trying to put here is between RADR and certainty equivalent approach. Just wanted to tell you what are quick things that are different. So first of all, here we talk about interest. Correct, students? Here we talk about cash flows. Correct? Here we adjust cash flows for risk. Here we adjust interest for risk, interest rate or discount rate for risk. Correct? What impact does it have? It reduces the net present value. Simple. And here it also reduces the net present value. Correct? How? Here the cash flow itself is reduced. Here, since the discount rate is increased, the automatically cash flow gets reduced. Okay. And in this, we have studied that the risk premium is same for all the years. Correct. But here we can have different risk adjustments for different years. As we have seen in the question above, right? In this, there is a different risk adjustment for the different years. Correct. So there is no need that the constant risk is getting adjusted. And the last point between both of them, which I wanted to make here is that either we use RADR or CE. We cannot adopt both the approaches at one in one example. Why? Because if you are using certainty equivalent approach also and you are using RADR in the same question, correct, then you are accounting for risk twice, because on one hand you have adjusted your discount rate also, and on the other hand you have adjusted your cash flow also. So both the things you can't do. Either you can apply RADR or you can apply CE. Hence, that is the reason in this question, since CE we have to apply, which is the certainty equivalent approach we have to apply, hence we have used risk-free rate of return. which is not covered under RADR, risk-free rate of return, is the simple return. Okay, this is one point which I want to all of you to note. Either you will use RADR or you will use CE. If you use RADR, then you will use risky cash flows. You will not use certainty equivalent cash flows. But if you use CE approach, then you will take riskless interest rate. Okay. Now Chetna had asked that risk premium is risk quantified in terms of percentage. Okay, so Chetna is asking that in the RADR approach, this risk premium that we have taken, where was it? RADR. Yeah, this one. This risk premium is actually not, this is not actually a standard deviation. I cannot say that. Why? Because see, in this case, this is a outcome of a standard deviation, right? This is not a standard deviation. Standard deviation in statistical approach is a totally separate thing. But here, because of some risk, 8% is the correct output that we can assume as a premium. To compensate for that risk, I can say that 8% is the right value, correct? To increase the interest. That is what the interpretation is. Okay, Chetna? But this is not a standard deviation. This 8% is not a standard deviation. Simple. It's just a correct value that I am putting to account or to compensate for the risk. Okay. Now, last point in this is, now I assume one example in front of you so that finally we will pack this RADR and CE concept. This will create a lot of proper thought process. So for example, today is 0 time period. After 1 year, this is 1 year, there is a cash flow happening of 1,20,000. Okay. So after 1 year, there is a cash flow happening of 1,20,000, and the additional information that we know is that the risk-free rate is 4% and the risk premium is 8% for this kind of a cash flow. Okay, and this is not a guaranteed cash flow. This is a risky cash flow. Okay, students. So this is a risky cash flow. This is not a CE equivalent cash flow. Okay. Now, if I talk about RADR, and I have to take a present value of this, what I will do? I will simply do 1,20,000 divided by 1 plus 8% plus 4%. I will use a discount rate of 12%, correct? Okay, I will use a discount rate of 12%. This I am putting under a box, correct? So 1,20,000, because RADR, it will ask you to take premium and risk-free rate. So I will do it like this, correct? This will be my NPV, or I can say the present value of cash flow, whatever it is, correct? But in certainty equivalent approach, you first need to convert this 1,20,000 to a risk-free, or I can say a guaranteed cash flow. That you can do how? 1,20,000 divided by 1.12, correct? You will take a present value of it first, and then you will multiply it with this 1.04. Okay, the moment you do this, let me do it on a calculator. Divided by 1.12, multiply it by 1.04. Yes, so this NPV, your answer is correct, Srishti. I think you have done this calculation. 120 divided by 1.12, correct? Yeah. So this will become as 120 divided by 1.12 multiplied by 1.04. So basically this amount comes as 111,428.57. If I divide it by 120, this will give me the 0.92, 0.9285. This is my CE certainty equivalent coefficient that I have derived. Chetna, you're right. Srishti, that answer is also right. 111, this is also right. Okay. So your certainty equivalent is this. Okay. Now, just to check it, whether it works right or not, what I will do is 120 multiplied by 0.9258, sorry, 85 divided by 1.04. Okay. If I do this, then this will also give me the same present value, which I would have got using the RADR approach. Okay. So I am saying in this case, we are just using the discount rates. In this case, we are using the certainty equivalent coefficient to arrive. So this is a certainty equivalent coefficient that I am able to derive from here. Multiplying in the cash flow and taking a present value will give you the same result that you will get from RADR. Hence, I'm saying both these methods are mutually exclusive methods. Okay. Now let us quickly go to question number 5. Srishti, your answer is correct. Okay. This you don't need. So this is just for an understanding. This example that I have given. Okay. So that your understanding becomes stronger. Now coming to question number 5. So question number 5 says it appeared in January 2021. A project requires an initial outlay of 3 lakh rupees. Okay. The company uses certainty equivalent method approach to evaluate the project. They have very categorically mentioned it that you will have to use CE approach. The risk-free rate is 7%. The moment we have to use CE approach, we have to use risk-free rate. We can't use risk-adjusted discount rate. We will have to use risk-free rate, correct? Okay, Nancy, I will come back to your query. Okay, then following information is also available. PV factor is given and CE factor is also given, the certainty equivalent. So what we will have to do, very simple and very easy. Just the previous portion we did, it's very simple. We will have to first multiply these cash flows with this CE factor and arrive at certainty equivalent cash flows. Okay. And that we will have to take a present value using the 7% for the which the factors are given. Simple. So can you all try this as homework, because this is very much similar to question number 4 that we did. Okay. Now let me come back to the query of Nancy. Nancy is asking that how did we arrive at 0.9285? Okay. So actually, Nancy, this is just an example to make you understand. Always in your question, the certainty equivalent coefficient will be given. Okay. And I have basically, because I already know that NPV and CE approaches will give you the same result. Hence, I have kind of tried to calculate it from here. However, the formula to calculate the CE coefficient is you have to take guaranteed cash flow divided by risky cash flow. This is the formula that you have to remember. Simple. That I have explained while explaining the concept of CE coefficient. Okay. Okay, Ayush Garg is asking why we divided by 1.12. I think you are asking, if you are asking in RADR, RADR is the concept that we have studied, that we will have to divide by 1.12. CE, since I have to calculate that coefficient, hence what I've done is I have taken first the value, the present value basis the RADR approach, and then again taken the future value basis the risk-free rate. Okay, so that I can get that cash flow which is riskless. This is a riskless cash flow, and hence I have calculated the CEO from this. Okay, but students, again I'm saying you can ignore all this. This was just to make your understanding clear. Okay. Manish is asking, will necessarily come and it will. Yes, Manish, that's correct. That's the understanding which is correct. So within this 1,20,000, if I strip this 1,20,000, so there is a guaranteed cash flow and there is a risk element or risk premium, I can say. So that is what it is. Okay. Yeah, let us go to the next question itself, which is question number 6. Okay. So question number 6 says following information have been retrieved from the finance department. I'm sorry. Yeah. Following information have been retrieved from the finance department of Corp Finance Limited relating to project X, Y, and Z. There are 3 projects that are given. Okay. Yes, I use 1.12 represents the risky factor, and Kamal, Srishti, I didn't get your point of negative 576 actually. That we will have to check, Srishti. Just let me know what are you trying to put on this negative 576. Okay. Yeah. So question number 6 says there are 3 projects, different cash outflows, different project life. There is an annual cash inflow and there is a coefficient of variation also that they have given. Okay. Very good. This information is fine. You are required to determine the risk-adjusted net present value of the projects considering the company select the risk-adjusted rate of discount on the basis of coefficient of variation. Simple. See here the coefficient of variation is just used in this table to derive that what is the risk and hence what is the factor that we have to use. Simple. So this is a question on RADR. Okay. Now let us quickly, first of all, see for project X, the coefficient of variation is 2. 2 is lying here. Against 2, the risk adjusted rate of return is 20%, for which the factor is 2.99 for 1 to 5 years. Okay. Okay, Srishti, let me check that the answer of question number 5. Okay. Whether it is negative 576 or not. I have not solved it, but let me check that. Okay, so Anil Kumar is asking what is the meaning of risk premium. See, risk premium in relation to the RADR is that what percentage of extra return you would expect on account of risk. Simple. So let's say risk-free rate is 7%. You will expect 8% more on account of risk. Hence, 15% is the discount rate that you will have to use. Simple. Okay. So this is 2, and hence this comes as 20%. The factor will be this. Project Y is 0.8. 0.8 is this. So 12% is the rate, and this is the factor that we will have to use. Similarly, 1.6 is this. This is the factor that we will have to use. Okay. Now let us quickly get on to the solution. So here we are first of all calculation of risk adjusted NPV, net present value. Okay, because that is what is asked in the question. So let me put all the projects here, X, Y, and Z. The cash outflow is what initially that is given 42, 24, and 20. 42 lakh, 24 lakhs, and 20 lakhs. And the risk adjusted rate that we have just identified, okay, it comes as 20% for project X, 12% and 16%. Annual cash flows given to us are 14 lakh, 8 lakh 40 and 6 lakh. Okay. And the PV factor, the present value factor from the above table itself, we can calculate as 3.604, 3.274. So the discounted cash flow will be given by 4186,000, 3027,360. This is nothing but this multiplied by this, right? Annual cash flow multiplied by PV factor is what we are doing here. 1964,400. Correct. Now let us calculate the NPV. So NPV for X, I think Srishti, your answer is correct. So 4186,000 is the cash inflow. The cash outflow is 42 lakhs. This will give us an NPV of 14,000 negative. Y is 27,360 minus 24 lakhs. So the Y project gives you a positive NPV of 627,360. Srishti, your answer is correct. And lastly, the Z project NPV is 1964,400 minus 20 lakhs. It will give you 35,600 negative. Okay. So these are the NPVs of all the three projects. According to us, Y is still better because the risk adjusted NPV is still positive for Y. Okay. So it is very clear. I mean, the question is framed in such a manner that using coefficient of variation, it is asking you to check the risk adjusted rate of return. Y is good option, right, Srishti? As I told you that the risk adjusted rate of return is dependent on standard deviation, or let's say the coefficient of variation or variance, right? Because higher it is, the higher the risk and hence the higher will be the premium, correct? Which is clearly evident from this table. Let us go to question number 7. Okay, so question number 7 says again, it's a very good question. The Textile Manufacturing Company Limited is considering one of the two mutually exclusive proposals. Okay, Project M and Project N, which requires a cash outlay of different projects have different cash outlay, 850 and 825,000 respectively. Okay, the certainty equivalent approach is used in incorporating risk in capital budgeting decisions. Okay, that's also okay. The current yield on government bonds is 6%. The current yield is 6% on government bonds. Now, students, please note, we are using certainty equivalent approach. Hence, we will need the risk-free rate, which is 6%. We will not go to the risk premium here, correct? The expected net cash flows and their certainty equivalents are also given. Project M and Project N. Present value, rupee 1 discounted, these are given as the present value factors. Analyze which project should be accepted. First of all, using the CE approach, can we find out the NPV? Yes. Okay. So, project M, let us see, I'm just doing a rough calculation here, okay, not a very fair one, because the question is very easy. So 4,50,000 into 0.8, this will give us a certainty equivalent cash flow. In this, let us multiply the factor of discount. Simply for 5 lakh also, which is the second cash flow, 0.7 multiplied by 0.890. 5 lakhs multiplied by 0.5 multiplied by 0.840. If we take a total of this comes as 8,69,80, and less investment is 8,50,000, which will give us a net amount of 10,980. Correct? This is the NPV, net present value of 10,980. Okay. Similarly, for project N, I can say that 450 is the cash flow of project N with a certainty equivalent coefficient of 0.9. Factor will remain same because the percentage is same, which is 6%. Similarly, here also 0.8 multiplied by 0.890, 5 lakh multiplied by 0.7 multiplied by 0.840. The net amount comes as 9,96,315. From this, we will reduce the initial cost, correct, which is 8,25,000 in this project. The NPV comes as 1,71,315. This is the NPV. So students, please note, in project M, we are getting this much NPV, and N, we are getting this much of NPV using the certainty equivalent approach. Very easy. Okay, now the second part of the question. So basically, using first part, we can say that N is a very strong case because N, the NPV is better. So we should use N, right? Instead of M, we should use N. The second part of the question says, if the risk-adjusted discount rate method is used, identify which project would be appraised with a higher rate. Definitely, high risk-adjusted discount rate will be there for that project which is very risky, correct? Which is higher in terms of a risk. Now, can you tell me just only by looking the certainty equivalent codes whether project N is risky or whether project M is risky? I would expect some good answers on this. Now, this is a very critical point, students. Can we say that, yes, Devolina, N is better? That is for the first part. Now, let's on the second part. My question is that only by looking at the certainty equivalent coefficients, can you tell me which project is higher risky and which project is lower risky? Definitely, project M is on a higher risk. Why? Because project M is having a lower coefficient of F, lower certainty equivalent coefficient, and that would mean that the risky will go down significantly when it gets converted into a guaranteed cash flow. That means the risk is high, right? So project M has a high risk as compared to project N. M is risky, M is risky, M is risky. No, Ayush, N is not risky. Ishika, you are right. Manan, you are right. Srishti, you are right. Okay. Ayush, please concentrate here. For example, there is a cash flow of risky cash flow of 1 lakh. In that, if you multiply 0.9, you will get 90,000. And in that, if you multiply 0.8, you will get 80,000. Correct. So this is your guaranteed cash flow. This is your risky cash flow. Correct. So you tell me between guaranteed cash flow and risky cash flow, here there is only a difference of 10,000, but here there is a difference of 20,000. So that means here higher the difference, higher the risk premium and higher the risk. Hence, I am concluding lower the coefficient of certainty equivalent, higher the risk. This is the main point that I want to leave you with. Okay. Just keep this thing in your mind that certainty equivalent coefficient, lower it is, okay, higher the risk. Okay. Chetna is saying N is less risky. Devolina, yes, you're right. M is more risky because it has low certainty. That's correct. Ishika, you're right. Okay. See, these some of the key things that I'm telling you is very important to understand from and to retain from the examination standpoint. Okay. Now let us go to the last part of the chapter, or let's say the okay, Ayush, thank you. Manish, project N has more deviation, so project N is more risky. No, 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 no. Manish, please don't conclude it from deviation. I'm just asking it from the face of the information that we have. Where was the question? Yeah, this one. See, here the question is between CE and RADR, right? So using CE, can we say that RADR it is risky or less risky? That's the only part. Okay, Manish. So what I was saying is yes. The next part, yes. So the next part is other techniques. This is again very easy, very simple. Please listen to this very carefully. First, we will cover the sensitivity. Yes, Ayush, you're right. It is inversely proportional. Anushka, N is less risky. Manish, okay, perfect. Okay, students, yeah. So let me move forward. Other technique, sensitivity analysis. Okay. This, I think, some part of it you would have touched in your capital budgeting chapter as well. So what does this say? I mean, what is capital budgeting first of all? Capital budgeting, I can say that is a kind of a model. Okay, this is a model in which there are certain inputs and there are certain outputs. What it will give you in the form of output? NPV, net present value, right? What inputs you will have to give? First of all, you will have to give what is the cash flow, what is the interest, or let's say discount rate, what is the time period. These are all inputs, right? And hence, while you will put all this into a model called capital budgeting, you will get an output of NPV, correct? Now within cash flows also, I can say you will get, let's say, cash outflow, cash inflow as separately, right? Now within cash inflow also, you might get sales, cost, fixed cost. These are the different elements. I mean, you can think n number of bifurcations as inputs, but I'm saying basic input will be cash flow, discount, time period. Using that in the capital budgeting model, you will put and arrive at NPV. Sorry. The moment you do this, yes, Srishti, you are right. Now, what is the sensitivity analysis? Let me relate. So, sensitivity analysis says that what if I change? Let's say I already have calculated my NPV using these set of inputs. Now, what if after calculating the NPV, I change some input, change in one input, and what result it will lead to change in output, which is NPV calculation. So let's say if I increase the cash inflow by 10%, or let's say decrease the cash flow by 10%, then what impact it will have on NPV? That is the sensitivity analysis. That will give us that our NPV is sensitive to which all factors. Okay, we will better understand this using the help of question. But the basic idea is this, that it helps us to calculate that NPV is sensitive using which factor? Let us go to question number 8 to understand this better. From the following details relating to a project, analyze the sensitivity of the project to changes in the initial project cost. This is our input number 1. Annual cash flow. This is our input number 2. And cost of capital. This is input number 3. So on these 3 parameters, they are saying how you are going to analyze the sensitivity. And the initial base case is given to us for all these things, and they also say identify which of these 3 factors the project is most sensitive if the variable is adversely affected by 10%. Please note it is mentioned as adversely affected and extent is given as 10%. Okay. Now let us first calculate the base case. The base case means whatever information is as is. Okay. So I am putting here as base case. In base case, the present value of cash inflow will be annual cash outflow is 45,000 for base case multiplied by this factor 10% for 4 years. Yes, Chetna, it's just like that. Which factor have a good amount of influence on the NPV? That's what is calculated under sensitivity analysis. So 45,000 multiplied by 3.169 and the project cost is how much? 1,20,000. This is a negative one. So if we solve this, it gives us 22,605. Okay. This is what? This is our NPV. This is our base case NPV. If we keep these factors as is, this one, and this one, then 22,605 is what we are getting. Now let us take the other 3 inputs and try to change all of them one by 10%. Okay. So Srishti, you are right. 142,605 is this, minus 120 is 22,605. Okay. Now, what if, first of all, I change the cash inflow by 10%? Please note it is mentioned as adversely affected. When it will get adversely affected? When cash inflow will go down. So, can I say 45,000 multiplied by 0.90 multiplied by 3.169? Correct? 10% my cash inflow is coming down. This will remain constant. See, other factors will remain constant. We are not going to change other factors. That's what the sensitivity analysis is. 83,445. The next factor, this is, let's say we have taken the second factor first. Now let us go to the first factor, which is this initial project cost. So project cost will get adversely affected in case it gets increased, correct? So again, I will take 45,000 into 3.169 and here I will take 1,20,000 into 1.1. In this case, I have kept these 2 factors as constant, correct? Then only I will be able to get that what is the implication of only project cost change. Okay. Now what I'm getting here is 10605. The last case is, the third case was cost of capital, right? Cost of capital is 10%. If it gets adversely affected, the cost of capital will be 11%. Okay. Cost of capital. 10,605. Srishti, you are right. Manish, you are right. So it will be 45,000 multiplied by what would be the factor for 11% for 4 years. It is simply given as 3.103. 3.103. Correct. And this will also remain as is. because in this we are trying to calculate the impact on account of change in cost of capital 19635. Now, if you see, if I just calculate the percentage change in NPV in relation to this, so basically 8344.5 in relation to 22605, this comes as 63.08 percentage change. This is the change of 53.08 percentage and 13.14 percentage. Okay. So, yes, Srishti, you are right. So, this, see, all the factors are getting changed by 10%, correct? But what is the factor which has the biggest impact is cash inflow, because in this case, your NPV is drastically coming down by 63.08 percentage. So I can say that the most sensitive factor is 63.08 percentage change, which is cash inflow. Okay. I hope this analysis, this discussion is very much clear what we are trying to do. What we try to do is we try to keep everything constant. Only one factor we take, keep on changing it and see what is the new NPV coming out to be. Wherever we feel that there is a big change happening because of the small change in a input, that is the most sensitive factor for us. Okay, students. Now, let me come to the last part called as scenario analysis. Okay, students. So, Bhakti, you are right. Your answer is right. 1965 is the answer for the third case in the above this one. Okay. So scenario analysis. Just now we studied sensitivity analysis. Now what is scenario analysis? Scenario analysis. See, in sensitivity analysis, always we change one input and see the impact. But in scenario analysis, now there are different scenarios. In scenario one, let's say it will have some set of inputs. Scenario two can also have other set of inputs, and all of them can change. Some of them can increase, some of them can decrease. So what I'm putting is that scenario will be, this is set of input 1, set of input 2. This is actually scenario 1, this is scenario 2. Okay. Let's say this is cash inflow, cash outflow. What I mean, these things will get derived using the set 1 of each set of inputs can get changed here. Okay. Yeah. So what I'm saying is that instead of changing the time, we can put another set of inputs here. Okay. For example, cash inflow can decrease by 10%, cash outflow can increase by 5%, rate of discount can be, let's say, constant. So this is set 2. Now we will take out for these different scenarios what is the NPV. That's all. Very easy and very simple. Okay. Now let us go to the last question of the assignment, question number 9. So Manish is saying which factor affects how much. That's right. So that is what we have also tried to calculate in the previous question. Why there is no negative effect on project cost? Ayush, we have taken the negative effect on project cost as well. This case, I have done 1,20,000 multiplied by 1.1, which will give you the negative impact because of the project cost. Okay. Now, this is a very good question, very beautifully drafted and very easy. I mean, I can say you have to be very careful in the last part of this question. Okay. Now, what does this say is PNR Limited is considering a project with the following cash flows. First of all, this is a question of one project. These are different years, cost of plant, running cost, and savings. Okay. So they have given us savings, they have given us running cost. So the cash inflow will be savings minus running cost. Cost of capital also they have given 12%. Measure the sensitivity of the project, okay, to the changes in the levels of plant cost. So they are saying that you take plant cost, you take running cost, you also take savings, considering each factor at a time. That means you have to consider one factor at a time, such that NPV becomes zero. You have to change these factors in such a manner that NPV becomes zero. And they have given us the present value factors at 12% for 0 to 3 years. And then they are saying that which factor is the most sensitive factor here. Okay. So first of all, let us calculate the base NPV, correct? That is where our majority of the work will be done. NPV, if I say this is 0 year, 1 year, 2 year, and 3 year. Okay. Cost of plant is 12 crores. Okay. Running cost. Okay, let me do one thing actually. Instead of crores, it will be easier if I just mention in terms of presentation 12, and I am here mentioning rupee crore. Okay. So 12 is there, project cost is okay, it's there only in 0 year. Then running cost is 4 here, 5 in the second year, and 6 in the third year, 6 crore. Savings is actually nil here. In the first year, it is 12 crore, 14 crore, and 11 crore. This is what the saving is, right? So, Srishti, that we will see how we can, without calculating the IRR also, we can see which factor is most sensitive. Okay. That we'll see through this part. Okay. Then, can I say that what is the net cash flow? Net cash flow for respective years, negative 12 plus 8 plus 9 plus 5, 11 minus 6, 5. Okay. PV factor is 1, 0.892, 0.797. This is basis the 12% discount rate. And hence the NPV is, if we just multiply with the respective factors, the cash flows, the total NPV comes as, I'm just mentioning it in again in crores, 5.86 crores. This is our NPV that has come. Okay. Five crore 86 lakh 40,000. Okay, 5.864. Now let us see if the NPV is positive 5 crore 86 lakhs, correct? And we have to make NPV as 0 such that we adjust these three factors one at a time. Then how will you do the calculation? Simple. First of all, let us see plant cost. Okay. For plant cost, when will NPV become 0? If the plant cost get increased from 12 crore to 17 crore, sorry, 18, sorry, this 12 plus 5 crore, right? 5.86. So which is 17 crore, 17 crore 86 lakh 40,000, correct? Then it will be NPV will be 0. That means the plant cost needs to be increased by 5 crore 86 lakh 40,000, correct? So can I say that percentage change required is 5.864 divided by 12 into 100, which will give you how much? 48.87 percentage. So if the plant cost changes by 48.87 percentage, increases by 48.87 percentage, your NPV will be 0. This is what we are concluding. Yes, Srishti, you're right. It has to be increased. Debolina, now savings we are coming to as a second step. Now, if we see savings, sorry, first we will go to running cost, because running cost is the second part. Now, if you want to make NPV 0, your running cost, the present value of running cost should be increased by 5.864, correct? 864 divided by the present value of running cost, because 5.864 is what the present value, right? So what I'm going to do is 4 crore into 0.892 plus 5 crore into 0.797 plus 6 crore into 0.711. 49.61 percentage is the percentage change in running cost that will make your NPV as 0. Manan is saying cost of plant increase to this, decrease saving and increase running cost. That's right. So we are saying that running cost needs to be reduced, needs to be increased by 49.61 percentage. Now let us go to the last part. Savings. So savings needs to be reduced in this case by 5.864. The present value of savings is how much? 12 crore multiplied by 0.892 plus 14 crore multiplied by 0.797 plus 11 crore multiplied by 0.711. Okay, if we do this, then the percentage change comes as 19.75% savings. So savings have to come down by 19.75% to make NPV as 0. Okay, now finally let me put it: plant cost, savings and running cost. So savings needs to decrease by 19.75%. Running cost needs to increase. This also needs to increase. Correct, students? And this increase and this increase is 48.87. And here it is how much? 49.61. Okay. Now, student, last question of my class is: can you tell me which one of these three, 1, 2, 3, is most sensitive to the project? I will wait for your answers, because this is, see, Anil Kumar is asking why NPV 0. Why? Because in the question itself, it is mentioned that you have to calculate sensitivity in such a manner that NPV becomes 0. Okay. So for taking NPV 0, what is the change in plant cost? Running cost, saving cost, we will have to do that. We have done. Okay. Srishti is saying, sir, this comes to 11.819 in running cost. Running cost is coming as 49.61. Srishti, just check it once. 19.75 is coming in savings. So this is the final and last question from the class today. Is that which one from these three is the most sensitive factor? So think logical and then answer. Manan is saying running cost. Okay. Rangavaluja is saying depending on which factor you are saying that increase or decrease. See, I'm saying savings is decreasing, running cost is increasing, plant cost is increasing. All of them are moving in such a direction that NPV is 0. Okay. Manish is saying running cost, Rangavaluja is saying running cost, Akansha is saying savings, Ayush Garg is saying savings. So I think Akansha and Ayush, both of you are correct. It's savings actually. See, Kamal running, no. Abhishek savings, Anil Kumar savings, Anupam Boduria running. Okay. See, the correct answer is savings. Okay. Why? Because in this case, see, in the previous question, now I'll tell you the difference. In the previous question, what has happened is we have calculated the percentage change on NPV. Okay. So just a 10% change in these inputs will lead to higher change in this case, somewhat lower change in this case, and the lowest change in this case. Hence, we said this is the most sensitive factor. Because on a like-to-like basis of 10%, the biggest change this factor is able to bring, which is cash inflow. But in this case, this is not the percentage change in NPV that we have calculated. NPV is 0 only in all the three cases. We have calculated that only 19.75% of change can bring NPV 0. Only 19.75% change in savings can bring down your NPV 0. On the other hand, if you have to bring your NPV down to 0 using plant cost and running cost, then almost you have to increase it by 48 and 49%. That means running cost and plant cost are not that sensitive. Correct? You compare these things as 10%, 10%, 10% in the previous question that was given. Okay. So I have got a lot of mixed answers, but I think most of you are conceptually thinking right. So Manan, yes, savings, because a small change in savings will make NPV as 0. Anushka, you're right. Chetna, you're right. Ayush, you're right. Srishti. Okay. So Srishti is saying that there is some different answers that she's getting. Okay, let me do one thing. Let me calculate and check it once. So I have taken the running cost, multiplied them with the factors to arrive at the present value. Okay, Srishti. So 4 into 0.892, then 5 multiplied by 0.797, 6 multiplied by 0.711. So the 5.864 divided by 11.819. This is the numerator and denominator. Okay. Abhishek, you're right. Savings. Okay. So 5.864 divided by the denominator will give you 49.61%, Srishti. I hope this is clear now, Srishti. Okay. This is how it is getting calculated, 49.61. So this is the numerator and this is all denominator. This is 0.711. Okay. Okay, students. So with this, we have done, I think, enough practice and we have seen the conceptual part as well. I will just take another 5 minutes more to run you through the entire thing. Okay. It is not over yet. Srishti, okay. I think this is clear to you. Sushil, savings, you're right. Ayush, yes, Ayush, the small magnitude of change in savings can make a product ignorable. That's right. Anushka, thank you. Yeah. So let me finish it through this finally. See, I'm just putting everything in this slides, in this 15, 16 slides, and we will just wrap up the session. Okay. This is just a revision that I'm doing. And in addition to revision, I will cover one theoretical part as well in this discussion. Okay. So introduction, we've seen that I covered that there are three types of scenarios in a decision making. One is certainty, second is risk, third one is uncertainty, right? This is what we covered. Now, this is one thing which I have not covered earlier. So, sources of risk, correct? What are the sources of risk? Now, if I say that this is a project, okay, project is held within a company. This is a company. Company is always part of a industry. I'm just giving you a very easy logic to remember this. Okay. So first of all, there is a project. Project is undertaken by a company. Company is a part of industry. Industry is a part of market. Because a lot of industries will make market, correct? And lot of market will make an economy. Correct? Okay. Lot of markets make an economy and lot of economies will make international markets. Correct? Now you just try to see. First one is project specific risk. Whatever is the very specific risk of project, for example, completion of project in time, error in estimation, right? Estimation of cash flows, that is the project specific risk. Now company specific risk is for company, as I told you, there is a credit rating in place, right? Due to which the solution happens. The interest rate will be derived by the bank. Changes in key managerial person, that is again a. So these are the types of risk within a company. Then let us go to the next one. Industry. The third, the company forms industry, industry forms market, market forms competition. Competition I missed there. Competition forms economy, right? So these are all different types of risks, correct? Economy is right. So these economical will be like inflation, GDP, savings, all those things. And last one is the international risk on free trade. So let's say between two economies, there is some free trade agreement, there is market access, there is some bilateral trade agreements, there is some forex related changes that will impact your cash flows, correct? So I am saying that this is a normal way to understand the thing. So I was here actually. Yeah. Okay. So project specific risk, company specific risk, then industry specific market. In market risk, I was telling that if in case there is changes in the demand conditions that happens, right? Or there is a substitute that has entered in terms of the product, that will also create the risk. Now, these are the techniques that we have all studied. Probability we have covered, variance, standard deviation, coefficient of variation also we have covered, right? These all three techniques are called as statistical techniques. Okay, already covered. Then we covered risk adjusted discount rate and certainty equivalent. These are called as conventional techniques. Then at last we covered sensitivity and scenario analysis. This is called as other technique. Okay, I'm just rewinding everything. So this was our probability. We say that it is a chance, likely cash flows, and we multiply the probability, take a summation. Net present value, we just divided it by the discount factor. Variance, we take it from the average, or I can say mean. What is the deviation? That is the variance. Standard deviation is a square root of variance that we have already studied. Coefficient of variation also we studied. It's basically standard deviation divided by mean. That will give you better analytics to compare two projects. Risk adjusted discount rate, we said that risk less profit, risk less interest plus risk premium. That we will have to take in terms of the interest rate. Okay. Certainty equivalent approach, we said that we have to use CE coefficient. Okay. Sensitivity analysis, we studied that if we change one input, what impact will it have on NPV? Reverse also we have seen in question number 9. Correct. NPV, if we make it 0, then what is the impact in input? Correct. That is a reverse scenario. In that case, the lowest factor will be the sensitive factor. Scenario analysis, we studied that there are different scenarios. Now within that, the inputs will keep on changing, and hence we will have to take the calculation. So that's all, students, from my end. I hope you really enjoyed the sessions. Just a second. Anil is saying, sir, will you please mention chapters that ask new method of questions? See, Anil, actually that question would be very difficult to answer, right? See, always think it that it's not that we will always go for the repeated questions, or the same set of questions should come, right? So you should always focus on the thought process, concept building, and then you should tie up that thought process, concept building with a proper practical question. Okay, so and then that question will be difficult to answer for me to mention the chapters. Okay, Manish. Okay, thank you, thanks a lot. So I hope, students, all of you really enjoyed this session. Sorry for slightly stretching it, but do revise this concept. Very easy, very scoring concept. And yeah, till the time, I mean, stay safe, and yeah, keep on revising the concepts. Thank you. Thanks a lot.